Hello traders, have you ever had a perfect daily bias, a perfect chart analysis with a really perfect point of interest, but for some reason you keep losing trades? I mean, it's a normal thing to lose trades here and there, but if you keep losing consecutively, then something isn't right. And most of the time, it's not your analysis, it's going to be your entries. So in this video, I'll show you the 3 worst entry mistakes that are destroying your trades and how to fix them. But before we get into it, please make sure to like this video and subscribe so you don't miss out on more smart money videos. And stick around until the end because I'll be sharing some really powerful bonus tips to take your entries to the next level. All right, let's get it. Alright, so let's kick things off with the first mistake, which is enter into early without confirmation. So it's very easy to get excited when price taps into your fair value gap. This can be a demand zone or a supply zone, but it doesn't mean that whenever price taps into your fair value gap, you have to enter immediately. It doesn't work like that. Most of the time you find that price can just give you a fake out and then stops you out just like that. When you had all your faith into that demand or a supply zone, whatever you call it. So the best thing that you need to do in this case, wait for price to sweep liquidity. Okay, after sweeping liquidity, it needs to give you a confirmation, okay, an entry setup that you need to enter into. All right, and this entry setup always comes in form of a market structure shift, okay, and a displacement. So when you have that displacement and you already have a swing high, you even know where to put your stop loss. So in this case, just enter right there into that displacement and put your stop loss above that swing high, and the rest is just going to follow. So this displacement is just a fair value gap that you need to look for. It's always going to be an obvious fair value gap. All right, so let's go to the second mistake. All right, so the next mistake that you can easily make is ignoring liquidity. So in this case, when you have price moving towards your point of interest, of course, maybe you don't even want to enter right on that point of interest, but sometimes price can leave you a liquidity pool. So this area right here, if you have double tops like that, that is a liquidity pool. So you don't need to enter a trade just because market gives you a market structure shift and a displacement. The moment you choose to enter right there into that displacement and place your stop loss right above those double tops, you are going to be part of that liquidity pool. Okay, so immediately price takes you out like that. If you were really patient and you know what is needed for you to enter a good sell setup, you should know that price needs this liquidity pool to be taken out. This is going to fuel the move that is needed to the downside. So when you just wait a little bit more, price is going to give you a new market structure shift and a new displacement. Okay, so when it goes back to that displacement, now you can enter and put your stop loss on that swing high. Okay, so always remember, just look at your surroundings. It's not every displacement or market structure shift that you need to enter into. Look at your surroundings. Is there any liquidity that is still lying there for price to be taken out? Okay, so let's go to our third mistake now. Okay, now the third mistake that traders usually make is poor stop loss placement. So with this one, it even says it in the title. You are just putting your stop loss where you are not supposed to put it. So we can start with the same one that is coming from the previous slide, where you have double tops. This is a liquidity pool. Okay, you need to make sure that you put your stop loss beyond key liquidity zones. If you put your stop loss right on those key liquidity zones, you are part of that liquidity pool. So you need to make sure you avoid all this. Okay, so when price now starts moving from here, okay, sometimes price can give you a market structure shift like this and a good displacement. But instead of price going all the way into that displacement to retest it, instead it makes a new market structure shift and a new displacement. So what you do in this situation is you don't necessarily have to enter here. Okay, the thing is you have two swing highs here. So price already made a market structure shift, and that is its swing high. And this market structure shift, that is the swing high. But this last swing high here is not safe for stop loss placement. So what you need to do is, the moment you see that there's a displacement right above an area where you want to place your stop loss, avoid that trade. Make sure wherever you are putting your stop loss, there's no fair value gap just right above it if you are selling. If you are buying, make sure there's no fair value gap just below an area where you put your stop loss. Okay, so that area on top, that swing high there, that is a safe swing high because it's protected by this fair value gap. Price can easily go through this displacement, okay, and then go to retest that fair value gap there. So when price goes all the way into that fair value gap, it means this swing high is going to act as a inducement. This is going to be your inducement. And if you know what inducement is, it's just a trap. Okay, it's a trap because it's meant to be taken out. So if you place your stop loss just here, if you place your stop loss just here, price is going to stop you out, okay, test that fair value gap, and then go your way. So make sure whatever you do when you are placing your stop loss, make sure you are placing it on a swing high that is protected. I'm talking about this safe swing high. Of course, it's going to be a bit bigger, but at least you are going to have a better trade. So instead of you entering through this, you can just wait for price, okay, for price to take out that inducement and then just enter into that fair value gap there. Okay, but if you made a mistake, maybe you made a mistake and started your entries down here, make sure you place your stop loss above that safe swing high, not down here. Okay, but if you are really trying to be really safe and minimize your risk, make sure this inducement is taken out and then you can enter your trade there. Even your risk to reward ratio is going to be better compared to when you entered into that other displacement. Okay, so let's go to the real chart and see if we can find the real chart examples. All right, so now we're on the real chart. This is the S&P 500 E-mini futures. This is the 1 hour chart. So the reason you need that 1 hour chart is for higher time frame point of interest. You don't want to just be going all the way to 1 minute to start entering. Of course, you'll find even the liquidity setups, but it's important that that setup is happening in a higher time frame point of interest. Okay, so the only two sessions I trade is London session and New York session. Okay, so we'll try to look for something in New York session here. So for New York session, I start looking for a setup starting at 8. Okay, 8 a.m. that's New York time. So here, as you can see on the higher time frame, you have a fair value gap there. Okay, so we have a 1 hour point of interest, which is going to be a fair value gap. All right, so when we go down to the 1 minute chart, when we go down all the way to the 1 minute chart, what you are looking for now is for price to have taken out liquidity. Okay, you are also looking for price to have a market structure shift and also displacement. Without all these things, you can just leave the trade, okay, and look and wait for another day. So as you can see here, if you look at this closely, you can tell that there was a liquidity build-up just here. Okay, there was a liquidity build-up just here. First of all, price has these double tops here. These two double tops, this is a liquidity pool right here. Okay, this is buy side liquidity. Buy side liquidity. Okay, so when you mark it like that, if you look downstairs here, you can see all these things happening. So price tends to be it tends to create some sort of uniform structures, okay, on top and downside there. So what's going to happen is, so this is sell side liquidity. Okay, what's going to happen is price needs to take out buy side first. Since you are looking for a sell setup, price needs to take out that buy side liquidity. Now when buy side liquidity is taken out, what you need now is to look for a market structure shift and displacement. So as long as buy side liquidity is taken out here and price tapped into my higher time frame point of interest, what I'm looking for is a market structure shift and displacement. So guys, when it comes to displacement, I don't want you to make a mistake of just picking random fair value gaps. Okay, you can see here price dropped to the downside here. Okay, price dropped to the downside here, which is fine, and even made a market structure shift here. But I don't want you to be picking a displacement that is not obvious. Okay, you can see, of course, this is a fair value gap here. All right, but when price makes a displacement, it's really obvious. It's more obvious. Okay, it's really obvious. You can tell they tend to be bigger. All right, not like this where just a small number of candles were dropping and then leaves that small gap there and then you are trying to enter. No, don't do that. Also, the reason you can't enter here, remember from those drawings, you can see up there, do not try to have to like this double tops here. This is buy side liquidity. So if you try to enter here and put your stop loss there, you might get taken out. Okay, price can just sweep you and then use you as liquidity and then drops to the downside. So do not ignore the liquidity pools. All right, so price made a new market structure shift here. This is the new market structure shift. Now you can see the difference between this and this. Okay, here it's more obvious. Okay, it's more aggressive compared to this. There's a reason it's called displacement. It displaces whatever was lying there. Okay, so now in this case, you just start entering your trades right into this fair value gap. If you want, you can also add. Okay, so you have this displacement right here. Okay, that's one thing. And you also have a market structure shift down here, but you also have this mitigation block here. So some people like placing their stop losses on top of mitigation blocks, which I don't recommend. Just use the swing highs, but it's also nice to add to your confluence. Okay, that is a mitigation block. Let me just remove it. There's too much stuff there. Okay, so the moment you start entering trades, right into that fair value gap, if you want, you start entering in the middle of the fair value gap, or you just measure that high to that low and then start entering right in the 50% level. Okay, so just put your stop loss above the swing high. Okay, just put your stop loss above the swing high to be safe. All right, so the moment you see price taking out uh, the downside like that, it's because of all this sell side liquidity that is lying just down there. Okay, now the way you take off your profits, if you want, for me, my minimum is 1 to 3 risk to reward ratio. So just here, you can take off some profits. Okay, if price continues dropping to the downside, that is good for you. Otherwise, just make sure you take off a lot of profits before it goes wherever it's going. Okay, so let's go to the higher time frame. Okay, so this is our trade right here. Okay, it hasn't even been hit by. Okay, so this was Thursday. Now on Friday here, we are going to do the same method. So whatever you do, guys, even if it feels like it's boring, just repeat the same thing every day. All right, look for a point of interest, then go downstairs there. So even here, let me remove this and just remove this. We look for a point of interest first. So here you have this mitigation block right here. If I draw a line, that mitigation block right there, and it has a fair value gap just down it. Okay, so we are going to use that mitigation block as our point of interest. So when we go down to 1 minute, first things first, start looking for that liquidity setup. Okay, look for where there's liquidity pools. Okay, can you see any liquidity pools here? You can see right there where this line is passing, that is a lot of liquidity there, right there. Okay, this is 9, so this was also this was New York session, so that's buy side liquidity again. Okay, so down here what we have is a trend line liquidity here. Okay, you have a nice trend line liquidity right there, right there. Okay, liquidity. Okay, so when price takes out that buy side liquidity, this trend line liquidity is going to act as your sell side liquidity. Okay, so first of all, it was taken out here, as you can see. So the only thing that you are waiting for now, since you are already in a higher time frame point of interest, you can see this line here. The only thing that you are waiting for now is for price to make a market structure shift and then give you a displacement. That's all you are waiting for. So price took out that high. You can see these other double tops. Okay, that's another buy side liquidity. So just be patient, wait for price to finish taking out its liquidity, and then you can enter. There's no reason for you to be rushing to be rushing. Okay, all right. So after price finished taking out that liquidity, it dropped and then made a failure swing there. Okay, it couldn't go and take out that high and then dropped again. So down here it made a market structure shift. Okay, this is your market structure shift, and took out trend line liquidity in the process. Let me just remove this so that it's more clear. A market structure shift, and then you have this displacement right here. You can see how obvious the displacements are. Okay, you won't even question yourself if is this a displacement or not. No. So you have a displacement. Okay, so the moment price taps into that displacement there, when you enter right in that displacement, and sometimes you really need to be quick because price just explode, it can just explode and leave you hanging down there, ending just up there, just with your 2 trades. So if you are planning to put on 5 trades, you really need to be quick. The best you can do is place sell limits just right into that displacement. It's going to help you a lot. Yeah, so that is your swing high, not that swing high there. That swing high, it has its own low here. This swing high, this is its low here. So just place your stop loss right above that swing high. All right, and then you go back to your 1 hour chart. Okay, so this is where we are right now. Okay, so price has already taken out external range liquidity here. You can see price already has internal range liquidity there. Price can go back and test internal range, but the fact that price has taken out external range liquidity right here, you need to be really careful with your profits. You can take off a lot of profits just here. Okay, so now for the bonus tips, guys, this is going to be very, very important. All right, so for the bonus tips, I just have 2 bonus tips. Okay, the first one is use the right time frame for entries. This is very, very important. So the thing is, many traders, they make the mistake of entering on the wrong time frame. Okay, so if you are using the 15-minute or 1 hour time frame for confirmation, your entries might still be too early. Okay, I want you to refine your entry using the 1 minute, 2 minutes, 3 minutes, or 5 minutes. Okay, never go above 5 minutes. All right, this is going to be giving you a lot of sniper entries with tighter stop loss and a better risk to reward ratio. So the myth that no, at least if you enter on the 5 minutes chart, it's going to be a better trade compared to if you go downstairs there. It just means that you don't really know what to look for when you are entering those trades. Even when you're on the 15-minute chart, it's still going to be the same. In fact, you are just going to lose bigger compared to what you are going to lose on the 1 minute chart. Okay, so please try to refine your trades. It's going to help you out a lot in the long run. Okay, the bonus tip number 2 is to understand the kill zones. So not all times of the day are ideal for trading. Okay, if you are entering outside of the London or New York kill zones, you are more likely to get chopped up, guys, because of the low volume moves. Okay, the best liquidity grabs and displacements often happen in these high volume periods, the New York session and London session. So if you want to better entries, trade within these kill zones for higher probability setups. So I even tell my students that it's very important that the moment you are entering your what, the moment you are looking at your chart, you are trying to look for an entry, make sure there's volume. Okay, there's volatility in the market. You can't just enter where price is just choppy. Okay, mostly it's just choppy in the Asian range. There's a reason it's called the Asian range. So it's better for you to understand the kill zones. It's going to offer you, you can see how explosive it was just in New York here. Okay, these are not coincidences. It's because there's a lot of volume already. All right, so guys, if you haven't subscribed yet, please subscribe, like this video. If you have questions or you just wanted to say something, please drop a comment in the comment section. Otherwise, I'll see you next time. Happy trading.